Good morning, everyone. I'm Nadja Freund, a realtor with Rolly Page, Cost Capital Realty, and you can find me under vicrealtor.ca. I'm getting a lot of questions asked about the mortgages, and of course, as a realtor, I know a lot about mortgages, but I cannot answer most of these questions, and that's why today I invited our trusted mortgage specialist, and I'm adding him. I invited Jason because our brokerage is working with him a lot, and I thought, well, who else if not Jason? Hi, Jason. Good morning.
Good morning, Nadja. How are you doing today?
I am pretty good. I'm excited about our first live stream, and I hope everything goes good. So please introduce yourself, because I don't know much besides that you are a mortgage specialist.
This is by the way, this is my first Instagram live stream ever, so it's very exciting for me. My name is Jason Chapman. I am the owner of Pacific Shore Mortgages here in Victoria. I've been a mortgage broker for 6 years, but I've been doing mortgages for about 23 years. I managed a mortgage underwriting division for 9 years, so I've seen a lot of applications. This would be like where all the brokers would send files in, and we would review them for approval. So I've been doing this a long time.
That's great. Yeah. Well, I have a little story to tell you. When I came to Canada 12 years ago, and at a certain point we were ready to buy a house, and then it said, oh, you should see a mortgage broker. And we're like, no, we're going to the bank. You know, we came from Germany back then. We trust banks. So we go to the bank. And for me, I had a little stereotype that a mortgage broker is somebody who will like give me money for the house, but then they will send collectors to me, and like I had so much like fear from the mortgage broker. That's my personal story. And then once I became a realtor and actually took another mortgage and started to get deeper into the topic, I realized how much more opportunities a mortgage broker can give people, especially self-employed people, towards the bank. Please tell us a little bit about the difference between bank mortgage and broker mortgage.
Sure. Well, basically, a lot of people feel the same way you did. I mean, banks they spend a lot of money on marketing. You know, little mortgage brokers around Canada don't have that kind of money to market ourselves. So you're not as comfortable. You may not be as comfortable working with a mortgage broker for the first time, because it's with probably a mortgage broker company that you've never really seen advertised too much. So, but the biggest difference is with a mortgage broker, you have access to 40 or 50 lenders instead of just one, right? We actually can probably access your bank because we deal with 3/4 of the banks in Canada. So if you like TD and you want to deal with them, well, I can help you facilitate that. But the big difference, a lot of differences that a broker can offer a lot more variety for clients, like a lot more options. Like if you were to go into your bank or credit union, you will only be able to, that bank or credit union has one set of rules and policies, and you may or may not fit those. And if you do, that's great. But then your next problem is, are you getting a fair rate, right? You don't know. The bank staff, I used to work at a bank, so I'm talking from first person. I worked at a credit union too. I know this is how it is the sales staff in the branches. You remember that they're salespeople, and they get paid a little bit more or a little bit bonus on mortgages that they don't discount or offer you the lowest rate possible. And how will you know you got the lowest rate possible? You don't know what it is. So you don't know if you negotiated the right way. This is a mortgage broker. Take all that out, right? We know all the rates. We know everybody's best rates. We have a lot more competition. So instead of just going to your bank and sitting in front of one person, you go to a mortgage broker, and now I can look at 40 different lenders that you fit their criteria and look at the best product for you. It is not always about rate. It is about product. Sometimes rate is not as important as what you're getting yourself into, but anyway, that's a whole different story.
Okay, well, thank you very much. It explains a lot because I also figured that the bank said, no, you're self-employed, you don't have steady income, you can't get the mortgage. And when I worked with a mortgage broker, I tried to get refinancing through mortgage broker. Then she said, I just need to know how much money is flowing to your business, Airbnb, whatever income you have, and then they collected that different than the bank. I don't say that the banks are wrong, but I just wanted to give a little bit trust into you guys. Like it's amazing what you can do, and I'm actually excited to work with with you when I do refinancing. But about refinancing, we'll talk next time. I think it's not our last time. There's so much to ask you. Okay, so I'm coming to you and then I say, so what is the percentage? What is the rate? What is that? Can you tell us a little bit short, not too much, probably not too deep to start with, about the like fixed rates and variable? What is the difference? Just very easy for people who don't know anything about that.
Sure, you bet. I mean, rate is usually the first question people ask. Rate is a complicated thing these days because the rates depend on how much equity you have and how much down payment. But generally, the difference between fixed and variable, let's just get to the question. Variable is just like it sounds. It's a mortgage rate that is variable over your term. The term typically being a 5-year period where you have. So variable means that your rate will go up or down depending on what the Bank of Canada decides their rates are. So Bank of Canada meets 8 times per year, and they decide to increase rates or decrease rates or keep them the same. And every time they make a decision, your mortgage rate and payment will go up or go down. Whereas with fixed is what it says. Your payment and your rate will not change through the whole term of your mortgage. So you know what your payment's going to be on day one until 5 years later on your last payment in that term. It's going to be the same. It is literally fixed. So they both have pros and cons, but that's a general difference between the two.
Oh, now I have 2 questions. Where do I start first? Because you said something about the terms, and when I started with my first mortgage, I didn't know what is a term, and I actually learned it and understood it when I was preparing myself for the Realtor exam. So what is a term? Why do you say until the end, but you're taking money for like 25 years, but then you're saying term?
Good question. Yeah. The term is the period of time that you have an agreed upon interest rate with the lender. It's typically 5 years, but can be as high as 10 or as low as 6 months. It's just a contract period. After that contract, you will discuss a new contract period. So rates may change. So you may negotiate a lower rate, or if rates are higher, you'll negotiate a higher rate at the end of your term. Whereas the amount of time to pay the mortgage over, whether that's 25 years or 30, this is the amortization. So the amortization doesn't typically change too much. So if you had an amortization today of 25 years, and you have a term of 5 years, then in 5 years, you'll negotiate a new rate, and your amortization will now be 20 years because you'll have 5 years less.
That's perfect. What we can do after the term ends, we will probably talk another time because, oh my God, I'm getting so many ideas what we can talk about. So perfect. I got another question from the girl who moved recently to Canada, and they started their jobs and are trying to figure out how much money do they need to buy a house. And besides all the extra costs that they will have about the transaction that I will talk about probably myself in one of the next videos, today we want to figure out roughly how much money do they need. If you can give us like very like one example, for example, English. Average house right now you can buy for like for a small couple, for a small family, is about $750,000. Let's say that. Is there a calculation we can make? I have some paper. I can write down some numbers.
I two tips for anybody who's watching. If you want to figure out how much of a mortgage you qualify for, quickly, without, this is not factual, this is like back of the napkin calculation that I might do if I was having coffee with a client. Take your annual household income and multiply it by 5.
Wait a second. Let me write it down because some people are more in the numbers.
Yeah.
So
your gross income.
Gross yearly income.
Yep.
Is it like this?
Yeah. Yeah. Your gross income. So that means before you pay taxes. So
it's annual income. It's GAI.
Yeah.
Like this. Okay.
Your gross income times 5. So if your gross annual income was $100,000, times 5 means you probably could buy something around 500,000. Okay. That's it. So that's not perfect. There are a lot of other variables, but if you're just trying to start with a ballpark, and you're making $100,000 and you're looking at homes 800,000, you probably know right away that's not quite. You're not quite there.
Oh my God. It's going to be 12, right? 125? Is that right?
Oh, I don't have a calculator with me. Yeah, that's probably about right. Yeah.
Ha, look what kind of calculator I have. Woohoo!
Oh, there you go. Fair. My phone is my calculator, but unfortunately I'm using it to talk to you right now.
That's 150, of course. I had the feeling I'm wrong. Sorry.
Yeah, 150. So that's about where you're at. The other thing, if some people they want to know how much a mortgage payment is, and I have a quick calculation right now for those people, if they want to know roughly how much their mortgage payment is, for every $100,000 in mortgage. Now remember, that's not the purchase price; that's how much you're borrowing. So every $100,000 in mortgage, the payment would be on a variable about $410, and on a fixed about $470, or on a fixed rate mortgage. So for every 100,000, so for example, if your mortgage was 700,000, your variable rate payment would be $2,870 roughly. And if it was on a fixed, it would be around $32.85.
Well, this is fair enough. So if your income per month is suddenly $4,000, then you cannot pay this at all. So you have to make sure that you have enough money to pay this, to pay the taxes, to pay the utilities, and so on and so on. That's what we will talk about next time. Myself, probably. I don't need you to talk about the taxes and utilities. Well, this is already pretty good numbers. Oh, my light went off. This is very helpful. Thank you very much.
No problem.
I have a couple more questions since we have a little bit more time. Variable, I was always taking the fixed rate, and then we had a talk with one of our statistic guys in the brokerage, and he said, well, over the period of 25 years, people who took variable always ended up being better. Is that true or not? Even if it goes up and down sometimes.
It is true. If when you think about fixed or variable, whenever you think about rates, period, anybody who's getting a mortgage and deciding what rate they should get, like fixed or variable, what should they do? They're making two bets. One, everyone knows the first bet, and that is I want to bet whether I choose fixed or variable. My bet is I'm saving money. I'm going to pay less interest over time. That's the whole point. That's the most important point that people think about. But there's another bet. There's a side bet, if I could explain this, that is each fixed and variable have different penalties. They are completely different penalty structures. And what's a penalty? It's simply if you pay a mortgage off early, what the bank's going to charge you for paying it off early. Yes, banks charge you for paying your mortgage off early. Now, why would you pay your mortgage off early? Everybody who goes into a mortgage, they go, well, I'm going to be there for 5 years, right? Well, a very surprising statistic is that 2 out of every 3 Canadians, so 2/3 of us, never finish a 5-year term. We pay our mortgage out for lots of reasons, because we want a lower rate, or we have kids and we need to buy something else that's got another bedroom, or we lose our jobs, or we get a promotion, we get transferred, we have family that's sick and we have to move to go help them, or whatever. There's lots of reasons. Life is what happens. So most people do not finish their 5-year terms, which means 2 out of 3 Canadians pay a penalty. Now, and it's very important to know, because, okay, well, what's that mean? Like a penalty? Well, if you take a variable, the penalty is a straight 3 months of interest. So when you leave, you're just going to pay 3 months of interest, which is like 1.5% of your mortgage, basically. But if you take a fixed, the penalty can be quite a bit significant. It can be, 4 to 4.5, maybe even 5% of your mortgage balance. Now, if you have a $500,000 mortgage, that's $25,000, right? That's a lot. It's a lot of money. If your mortgage is bigger than that, of course, it's more. So it's a really important consideration. It's not, first of all, with variable always starts at a lower rate, but could go up, right? So you have to be comfortable with your mortgage payment going up, but it starts out very, very low, lower than a fixed. Whereas fixed just gives you the satisfaction and guarantee that things won't change. So these are the things that we're considering when I talk to clients about choosing fixed or variable. Really understand their 5-year plan and how sure they are on it. Statistically, over time, variable outperforms fixed. It just doesn't come with the security. But when you look at all the money factors, if you just keep taking variable over your life, you're like, I don't know, 100%, 99% chance that you overall saved yourself money.
Okay, so just so for me to understand, if I'm taking variable and pay, for example, $2,500 a month mortgage, how much fluctuates it over, like with the change of the rate?
Good question. There's no real set determination on how often it's going to change. It depends on factors like things that the Bank of Canada needs to use, their monetary policy to keep inflation in check, or to stimulate the economy. So when we were going through COVID, rates came down because the government, the Bank of Canada was trying to stimulate the economy, give cheap money for these businesses to borrow, because it was a really hard time for everybody. So we can't predict the future or the economy. Right now we're seeing interest rates are rising, because right now there's the cost of goods are more expensive. Things are getting more expensive. So inflation is up. When inflation goes up, the tool the Bank of Canada has to lower inflation, to keep it from these costs from rising, is to withdraw money from the economy. One way to do that is to increase increase the Bank of Canada money, which increases everybody else's cost to pay on a variable mortgage. We're talking mortgages here. Mm-hmm. But it affects other things as well. It affects how much businesses can borrow. It affects how expensive it is to borrow. And if you're like Sally down the road and you're wanting to buy a new TV, and when money's cheap there, and you have lots of money to spend on a TV, it's great. So the manufacturers can increase the cost because you'll pay it, because everybody wants a TV. But then when things start getting more expensive and there's less money in the economy or in your personal life, you decide, maybe I'm not going to buy that TV. And that manufacturer now starts to lower their prices because there's not as many people buying it anymore. So they increased interest by lowering the price again. So it's a long way to say that's why the Bank of Canada does what it does.
Okay.
Yeah.
But it wouldn't be still like payable, or people would suddenly start like, oh my God, I can't afford it anymore. Like, is it going to grow like twice as much, or is it just, we're talking about several $100s, like under $1,000 plus and minus?
Well, anything is possible. In the 1980s, interest rates went up to like 16%. Okay, so these things are possible. How likely? Very, very unlikely that that's ever going to happen again, because there's just more sophistication in the financial system, but it's possible. But how much rates could go up? Well, they could go, like a variable rate could go up to 2.5% in the next 5 years. The Bank of Canada is actually meeting this Wednesday, and we predict they're going to increase the rates by 0.5%. So a variable, right now you might have a variable, say you're paying 2.6%. Next week you could be paying 3.1. If the predictions are correct. We don't know what the Bank of Canada is going to do. And then as things evolve, they could increase them again. So they can only increase them 8 times a year maximum. But what they typically do is increase them or lower them, then sort of wait and see, what's happening in the market, then adjust them again. So they could do it fast, or they typically do it slow, but right now we're expecting to move them a little quicker because inflation is really high. So they don't have as much time to wait and see right now.
Yeah,
so
they
yeah,
want
rates,
money.
yeah, variable rates, they will be going up, and they are. We're seeing that already.
Ooh, okay, that's a tough time, I guess, but they will go down again one day.
Yeah,
let's hope for that.
exactly.
Yeah, you were talking about the penalties. I remember I have a fixed rate, and I had 1.5 years left until the end of my term, and I wanted to refinance, and because I figured out what is actually refinancing. Probably we still have a couple minutes, we can talk about that. And my bank said, yeah, so your penalty would be $12,000. It would be still good because the rates back then were nice, and I have like 3.4 something percent on my fixed rate, and they offered me with 2% refinancing, and it would be still like this 12,000 will just disappear in that money.
Yeah, exactly.
So refinancing, it doesn't mean that you bring a chunk of money in. It means also that you can take a chunk of money out.
Exactly.
Can you very easy explain what it is?
Yep.
In easy words?
Yeah, refinance is basically taking available equity in your home and being able to take it out for whatever purpose you need. You might need to refinance because you have some debts you want to pay, or you might want to take money because you want to buy a car, or invest it, like put it in your RSP or whatever investments that you have. Or parents might want to take out money in their home so they could give an early inheritance to their children, or help them buy a home or whatever, or buy a second home. So there's lots of reasons why you might refinance. You still have to qualify, and you have to have equity in the home. So the rule on refinancing is you have to leave in always 20%. So if the value of your home is $1 million, you must leave in $200,000. So that means you can only borrow up to $800,000 if you qualify. So
that makes sense. So they protect themselves. Protection, insured and uninsured mortgage, that was also a thing. Can you tell a couple words about that?
Sure. So the difference between insured and uninsured mortgage. An insured mortgage is basically a mortgage that is insured through Canada Mortgage and Housing Corporation, CMHC, or other comparable. There's 3 insurers in Canada, and they insure lenders against default. So if you don't pay your mortgage back, or you run into some financial difficulty, and the lender or the bank is not able to sell your home to recoup the mortgage, and they sell it for less than it's worth, less than your mortgages, then they can go to the insurer and they get paid. So in Canada, if you have less than 20% down payment, by law, you must insure the mortgage. So you have to pay the insurance. You pay it up front. It's added to your mortgage. You don't have to. It doesn't have to come out of your pocket, but you have to have. Pay for the insurance. You have to be insured. Uninsured means like you're not able to get the mortgage insured. So anything, like insured mortgages have to be less than 20% down, purchases, and owner occupied only. So those 3 things must happen. If it's a rental, or you want to refinance, or you want an amortization more than 25 years, it becomes uninsured. You can't have insurance on it because you don't fit the insurers won't lend on those criteria. So that's the big difference is insured is the lowest risk mortgage for a lender. You get the best rate, even though you're putting probably the least amount of down payment. But yeah, so that's the big difference. So mostly it's less than 20% down means you're insured.
But what is the minimum of down payment you need to purchase a house?
In Canada, it's 5%.
Okay.
There is some scaling. So if you get up to, it's 5% is the minimum. But if you purchase something above $500,000, so if the purchase price is $500,000 or more, then you have to pay 10% on the amount above 500,000. So to make that make sense would mean like if you're buying a home.
Let me write it down so we can make it visual, because numbers and visual is always good.
Perfect. Okay.
Okay, so we have.
So let's say you buy a house for 500,000. You have to put 5% down payment minimum, which is 25,000. Okay, so now let's say you buy a home more than 500,000. Let's say 700,000 to make it easy. Okay, so you have to pay 5% on the first 500,000 of value. So
we still pay 5. What do we pay?
On the first 500,000, you still pay 5%. So in other words, you'll pay 25 on the first 500,000 of value. Plus, now there's this other 200, the amount above 500,000, which is it's 200,000. That portion you have to pay 10% on, which is 20,000. So if you were to buy a house of 700,000, it would be exactly 45,000. 25 plus 20. Which is more than 5%. It's going to be like 5.7% or 6% or something like that. But that's the calculation that you need. That's a minimum requirements in Canada. And that's how the calculation works.
That is very visual. I understand it now. Thank you. And another question. I just had in my head, where did it go? Minimum. You said something in between, and then I got lost.
Maybe I can help you with one more thing that we could add to this.
Sure. Yeah.
I don't really need to calculate this, but it should be known that the maximum purchase price for putting less than 20% down is $999.99.
Okay.
Yeah.
So this is maximum for how much?
For the minimum down payment.
For minimum.
Yeah.
Down payment.
Now, if you purchase, if the purchase price is $1 million or more, you must pay 20% down payment. No option.
Interesting.
Currently, yeah. So that's a magic number. It's anything over $1 million is not insurable, which means you must put 20% down there. Just by definition of what insurable is. Yeah.
Okay. That's my beautiful
important.
handwriting.
Well, we think there will be changes in the government to change that rule, because as you know, $1 million is not an expensive property anymore in Victoria. So
yeah.
So there are discussions in the government. They may make some changes to allow, minimal down payment for homes above $1 million, but right now it's not here.
Awesome.
Yeah.
Well, it's good, very good information to start with. I think we are like now half an hour down. I think half an hour is perfect time to watch a show like that, because there's a lot of information, and we would ask our whoever is watching this show, our friends, our viewers, please send us more questions and we will answer them, because I think it's a very good idea to make some videos and explain it also visual, even before you start with the mortgage, or now after you had certain time a mortgage and want to refinance, pay it off, or whatever you're going to do. And you can ask us questions, we can answer them, because it's very important for people who are new to it too. And I will prepare also more questions, and I hope to see you in the next couple of weeks again online. And if you have to say something, you can also add it. Please subscribe to our Instagram channels, and I have also a YouTube channel. Do you have one?
No, I'm not as my social media is not as on par as you.
Okay, well, Instagram is good enough. So we have Pacific Shore. No, Mortgages Victoria. How do you say that? What is
for Instagram? It's Victoria BC Mortgages.
Victoria BC Mortgages.
And my company is Pacific Shore Mortgages. You can find me on Facebook or on the internet, obviously. And if you have any questions, don't hesitate to shoot me a message.
Perfect. And my name is Nadja Freund. I'm vicrealtor.ca, and you can find me as Nadja_Freund_Realtor on Instagram, and the same on YouTube. Well, thank you very much for watching. Thank you very much for being here and answering all my questions. And it went well.
Terrific. Have a good day, everybody.
You too. Thank you. So I will have to stop it now and then save it. This is the most important part of saving. Okay.
Okay.
See you.
Bye-bye.